litigation risk has become increasingly important from a bank's perspective due to the rapid rise in climate-related lawsuits and probes over the past few years. Some sources indicate a 12-fold increase in climate-related litigation across the globe and against banks between 2020 and 2023. This surge in legal challenges poses significant financial and reputational risks for banks, and particularly those with misaligned credit portfolios or unfulfilled climate commitments. Banks face scrutiny over their role in financing carbon-intensive sectors, implementation of environmental policies, and progress on transition plans. As regulatory frameworks evolve and public awareness grows, banks that fail to adequately address climate risks or deliver on their sustainability pledges may find themselves vulnerable to lawsuits from non-governmental organizations, clients, investors, and shareholders. This emerging risk landscape necessitates that banks develop robust climate risk management strategies and Paris-aligned transition plans to mitigate potential legal and reputational damage.
What is climate litigation? Well, at this stage, I think we can very readily describe it as a worldwide phenomenon. The United Nations have defined it as those cases that raise material issues of law or fact relating to climate change mitigation, adaptation, or the science of climate change. In essence, what we've been seeing is that activists are increasingly turning to the courts to seek to address the urgency of climate action. And we saw quite a significant increase in the number of cases brought since the Paris Agreement was concluded in 2015. About 1,800 cases, or 70% of the cases listed on the database by the Sabine Centre for Climate Change, 1,800 have been recorded since 2015. So as a result of this massive increase in litigation, it's been identified that these cases can be increasingly relevant, and not only for the broader economy, but also for the work of central banks, supervisors, and indeed the financial system and banks more specifically. And this has been identified in a number of reports produced by the Network for Greening the Financial System. This network, in case you're not familiar, was founded in 2017. It's a voluntary grouping of central banks and supervisors from across the world. Obviously, if you have a successful claim, it's going to have some direct financial impacts, especially in terms of legal costs, in terms of damages and fines, and of course in terms of adaptation and compliance costs for the company involved. However, litigation does not need to be successful for some of these costs to materialise, especially when you think of legal and administrative costs associated with defending the claim, when you look at things like the impact that the claim may have on the value of the firm, its creditworthiness and its financing costs. The impact on the share or stock price of the company may arise already at the time when the claim is first brought. And of course, inevitably, you will have significant reputational costs. There can also be implications for the availability and the cost of insurance. And all of these need to be taken into account in the context of prudential supervision, where the work of the NGFS has highlighted that climate litigation can be considered a driver of other prudential risk categories, a driver of risks such as credit risk if a company to which the bank lends is challenged, operational risk for the bank involved, etc.
The key question is whether climate change can speak risk, because that is the language of bank regulation. And the clear answer is yes, fluently. This comes from the NGFS diagrams. One can see the different sources of climate risk. One can see the economic transmission channels, both micro and macro. And one can see the materialization of this in the different types of financial risk. One can see that legal liability from failure to mitigate or adapt is already identified as one of the economic transmission channels. But to go even further, climate litigation risk can also speak the language of risk fluently. This is an extract from Mark Carney's very famous speech, Tragedy of the Horizon, and already almost 10 years ago, he identified liability risk as one of the main drivers of climate change risks into the realm of financial stability and, of course, including risk. The words that are highlighted here are just to illustrate that even Mark Carney could not fathom the impact that climate litigation would have, because he's thinking about a scenario where climate litigation comes after physical risks have materialized, whereas where we are seeing now, as Marguerite very well illustrated, is a wave of litigation lawsuits that anticipate the risks that are being created. Now, the fact that climate change and climate litigation speaks the language of risk doesn't mean that the translation is perfect. There are elements related to climate risk that are not entirely captured by the framework of prudential regulation, related to complexity, uncertainty, the policy and political dimension, and social norms.
The fact is that a lot of the uncertainty today is being driven by the changing regulatory environment. So shifting ESG expectations and political pushback against ESG in some places, at the same time as you are seeing new compliance frameworks around disclosure and reporting and diligence, etc., in other places. So over here in Europe, we may think there is complete consensus on the direction of travel as we've been kind of seeing it in the past few years since the Paris Agreement. But now, for example, in the US, things seem, especially now with the change in administration, to maybe pull banks in the opposite direction from where we've been going over here in Europe.